Professional options traders are taught a wide variety of option strategies which are intended for different market situations. I'm Seth Freudberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the professional traders on our desk are trained to identify which option strategies are appropriate for which market circumstances. In this video, we're going to be covering two option strategies and how they can be applied to two very different market conditions and why. So if you're interested in adding two option strategies to your playbook to respond to two distinct market regimes, then stick around because I think you're going to find this interesting. Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so option strategies basically break down into two broad classifications: market neutral strategies and directional strategies. And there are many different kinds of trades that fall into each of these two classifications. Just like they sound, neutral strategies are the approach that options traders take to profit from situations in which the market is likely to be in a tight price channel, and directional strategies, on the other hand, are used when traders pick a direction for the asset they're trading. The two strategies I'm going to be teaching you are going to involve examples using the Russell 2000 index option. So before we get into it, I want to make certain that everyone watching understands how index options work. If you do understand them, then don't worry. This is going to be really quick and we'll jump right back into the lesson, so bear with me. Okay, so now almost all of you are probably familiar with equity options, where a call buys you the right to buy 100 shares of a stock at the strike price of that option anytime before the option expires, and a put option entitles you to sell 100 shares at the strike price of the put before that option expires. But there are also index options, which work similarly to equity options, except there's no such thing as 100 shares of an index like the Russell 2000 index. You can't really buy or sell 100 shares of an index, but what you can do is to get paid in cash, $100 per point, if the index expires above the strike price of an index call that you buy, or alternatively, you'd be paid $100 per point for each point the index drops below the strike price of your index put. So for example, if the RUD index is trading at 1350 and you buy the 1360 call, if the index closes at 1365, you'd receive $500 in cash in your account. If the index closes at 1360 or lower, on the other hand, your call expires worthless. On the downside of the market, if you buy a 1335 put and the market sells off to say 1325, you'd make $1,000. But if the market just sold off to 1335 or higher, the put would expire worthless. So those are the basics of index options. And remember, you can buy options, but your broker will allow you to sell options as well. And your broker will also allow you to put together combinations of options. In other words, options strategies that involve both short and long options purchased in a way that is advantageous to you as a trader. Okay, so now with that said, let's take a look at the first 6 months of 2019. And as you can see, the Russell index was trading in a fairly stable range of 1450 to 1600 during that period of time. And so with that much of a clear definition of a trading range, many options traders, particularly because we would have been heading into the summer months, would have assumed that the index may well stay in that range. And so an experienced options trader might decide to utilize a strategy known as the iron condor, which is a powerful strategy to use in channeling markets. So let's say that a trader's thesis was that the market will continue to channel for the rest of the summer as it had for almost the entire first 6 months, and then perhaps break out to the upside or break down after Labor Day. That would not have been an unreasonable thesis, given the fact that the market often gets very slow and sluggish during the summer. So let's say the trader looked at this chart and said, okay, so if I construct a trade around this price channel, this 1450 to 1600 range, it may have a good shot at working out. So let's say that the trader decides to enter this position. He picks a price 20 points above the high end of the range and sells 10 calls at that point, then heads down on the put side and sells 10 puts 20 points below the range. Then for protection, he surrounds those with 10 long calls 20 points above the 10 short calls, and the opposite on the put side, where he buys 10 puts 20 points below the short puts for protection on the downside. So now this entire combination, the short calls above the market and the short puts below the market, surrounded by long options on both sides, this formation is known to options traders as an iron condor. And as you can see, it will run through August under our trader's thesis that the market will be kind of sluggish over the summer. Now, before we get into how this trade plays out, I wanted to let you know that beyond what we're teaching you in this video, there are a large number of sound, viable, long-term techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop where we'll be teaching you 3 of those strategies that real professional options traders use, including a really simple but incredibly effective strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with the stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so let's first do a cash flow analysis of this trade so you can understand what's at stake and what the potential rewards are. Well, first off, we sell the 10, 16, 20 calls above the market for $17.35, but remember that represents $100 per point, so that's multiplied by $100, and we bought 10 of them. So multiplying that by 10, we arrive at an initial cash flow of $17,350. Now, we also sold 10 of those 1430 puts for $8.35, and so by the same logic, we receive $8,350 for that sale. Now, the protective 1640 calls, well, those cost us in total $11,100, and likewise, the protective 1410 puts cost us $6,700. And so when you net it all together, the result is a cash inflow of $7,900 when you first start the trade. Now, your broker is going to require you $12,100 in your account for this transaction, and that amount serves as the maximum risk on the trade, by the way. So now let's take a look at a chart of the RUT index over the next 2 months. And as you can see, as expected, the index maintained its channel between 1450 and 1600, as often will happen over the summers. Many investors and traders take vacation and otherwise don't make any major moves. So let's take a look at this iron condor trade on the day that it expires, which is August 30th. And as you can see, the index closes at 1494.80, which is well above the short and long puts and even farther below the short and long calls. And so let's analyze the implications of that. And as you can see, it's pretty staggering, because just think about it. The long 1640 calls and the short 1620 calls, well, they both expired worthless, as they have no value unless the market closes at above their strike prices of 1620 and 1640 respectively, which the market obviously did not do, so they go out worthless. Similarly, the 1430 and 1410 puts also expired worthless because the RUT index closed well above both of those, and they have no expiration value unless the market closes under their strike prices. And so all 4 options go out worthless. So what that means is that the initial positive cash flow is your profit. That $7,900, you get to keep that because you're sitting there with 4 worthless options and they just die, leaving you with the original $7,900, which is a 65% return in 2 months. Not bad. Now let's turn to a very different scenario, and that took place in early March of this year when the COVID-19 pandemic crash took place. And as you can see, that started in late February, but then on March 9th, you can see that the RUT's long-standing 1450 area of support that was basically supporting the index all of last year cracked. And so traders might have at that point logically reached the conclusion the market was about to go into a free fall, and so now that is when the skilled professional options trader pulls out another tool. This is not a case where the iron condor, a great strategy for a range-bound market, would make any sense because there was a major support break. And so the range that you would have relied upon in a neutral iron condor trade, well, that's gone. We don't know where the market's headed now. In other words, this is not a time for a non-directional trade. But the interesting thing is that the iron condor contains an element that we can use to our advantage in this very directional scenario that we've just entered into. And so the trader could decide to employ what is basically the top part of the iron condor trade, which is known on its own as a call credit spread, and just enter into the call side transaction that we're showing you here, in which we sell the 1380 calls pretty much at the money on March 9th and buy the 1400 calls for protection should the market bounce. Now, as we did before, we'll take a look at the cash flow on this trade. And as you can see, the short calls were trading for $43.40. So with that $100 multiplier we mentioned before, and the fact that we sold 10 of those, we get a credit of $43,400 for the calls we sold. And the protective 1400 calls, should the market bounce, well, those cost us $32,350. And as you can see from the calculation, and so the net effect is a cash inflow of $11,050. A trade where your broker will be requiring you to have $8,950 in capital to make the trade, the maximum worst case scenario on the trade. And so with this bearish premise in mind, let's move to the day these options expired. And as you can see, the rut did indeed crash after it cracked support. And by the time these options expired on March 20th, the rut had dropped all the way down to 1,000. And so with the trade having expired on that day, if we look at the expiration value of the options, we'll see that both the short and the long calls expired worthless because the market had closed at 1,013 on the day that these options expired. And so having no value unless they expire in the money, both of those calls, which are far, far above the market price of the rut, had expired worthless, leaving us, as they did with the iron condor, with a trade where the original cash flow, again, is the trade's profit, in this case over $11,000 and well over a 100% return. And so what I'd like you to take away from today's lesson is that professional options traders use a variety of trade strategies to achieve their goals. They have a whole tool chest of trades for non-directional situations, like that in 2019 channeling of the Russell 2000 index where we won with an iron condor neutral strategy. But we can also win when the market's clearly taking a direction and utilizes strategies such as a bearish call spread in those situations to leverage options to your advantage in directional situations. Professional options traders have both tools in their playbooks and use them with discretion because of their knowledge of how options work and respond to varying market conditions. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it, would like to learn the details of 3 more real-world option strategies that professional traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so you won't lose this video, don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so you won't miss all of the free trading videos that we're posting constantly on our channel to help you to improve your game as a trader.